When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about direct indexing versus mutual funds or ETFs, also the unique needs of high net worth investors. We'll answer listener questions, and then finally we'll talk about Q3 and Q4 planning and what we're looking for in 2026. My name's Jeff Shea. As always, I'm just here to ask the questions with the words of wisdom and solid advice that come from the other Jeff in this radio program. It's Jeff Fogan of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
I'm doing great. How are you doing?
I'm doing fantastic. Thank you. The calendar is beginning to turn here to September. Pretty soon, the license plates are going to be turning. Have we seen many out-of-state license plates so far this year?
Well, yeah, all year long. California, they're exiting that state. Nobody likes to live out there anymore. Newsom burning it down, so they're all coming over. Yeah, I don't know. It's a lot more California plates. I haven't seen the Midwest show up yet, but
they will.
They're soon to be here.
Well, I took a little drive around on a Saturday, and again, I'm always impressed here in Tucson up and down Oracle Road, where you and I tend to frequent, how little traffic there is on a Saturday morning, but I know that that's going to ramp up here pretty soon, so get ready for that. Whether you're local or whether you're visiting, we're always glad to have you listening to us here at Premier Retirement and our radio show. So let's talk about an investing approach, Jeff, that you may have heard about, direct indexing. How does it stack up against more familiar tools like mutual funds and ETFs?
Direct indexing, if you just want to buy the index. The thing with the indexes is, I've mentioned this before, some of them were kind of manipulated into kind of a cap-weighted situation where you really get a lot higher participation with like the Mag 7, the Netflix, NVIDIAs, the Microsofts, Googles, Meta, and Teslas, and the major big companies. And then they weight them based on their market capitalization. So you could have 7 stocks driving the entire index. So there is a way to maybe take advantage of that, because most mutual funds can't beat an index because they're not necessarily weighted to those stocks because they've got a more diversified stock mix, and typically they don't overweight a certain stock. For example, if we manage money, typically we don't have more than maybe 5 or 10% max in any one particular position, but you get those top 7 positions in the S&P 500, even though there's 500 stocks in there, making up 50% or more of the entire gain for the year on that index. So there are some reasons that you might want to play it. If the market sells off and those overpriced cap-weighted stocks sell off, you could end up losing more in the index than you would on a mutual fund that's more diversified. So it kind of goes both ways. It's a double-edged sword when you index. Bottom line is most people can't pick stocks. Most people don't get enough information quick enough to make informative decisions. They just buy hot stocks, and most people who trade and base their investments on what's hot or what the news says or what Kramer or somebody on TV says typically lose money. And mutual fund managers do a lot of research and due diligence before they buy a stock. Typically they buy it and they dollar cost average in, they hold it for a long time, and they build a portfolio that they feel is going to run long term. Mutual funds in general are built to be a managed portfolio rather than just a sampling of 500 stocks out of the 5,000 or so that are out there, to be a representation of basically the major players in any given market. You know, there's all the big tech companies, and some companies that weren't so big before are now starting to enter in. We've got some companies that we haven't heard of in a long time, but they got so big so fast that now they're starting to be players in the S&P and some of the other indexes. NASDAQ, of course, the Dow only has 30 stocks, so it's kind of hard to get on the Dow, but we've had stocks like Intel, which has been a horrible player, been one of the 30 stocks at Dow for years. You know, Apple and some of these other companies that have been players are still representative of the upward momentum of the market, but there's others that aren't. So what the Dow does, every once in a while, they'll just kick a stock like Intel out and put somebody else in. If Tesla gets too crazy, maybe they'll reconsider it for whatever indexes it's in and so forth. They might not even call it a Mag 7 anymore. They might say, oh, well, that's not as good as one of these other big players. We'll call the Magnificent 7 or the Magnificent 5 or the Fab 5 or the Super 6 or whatever it is. The small handful of players that manipulate the index will probably have a name and have a focus. Some people just jump in and buy 2 or 3 hot flying stocks and do really well. But again, those are the stocks that could also come back and bite you in the rear and not do so well over time. As a financial advisor, I can't put somebody into just a handful or just a couple of stocks, because if the market falls and those stocks end up getting bad news or have bad returns or get sued, or something bad happens to that company or that product, or another company comes in and competes with that product and that stock goes down, you can sue your advisor in his business, unfortunately, when they do things that are not diversified and not necessarily considered wise financial plans. Yet individuals do it all the time. NVIDIA millionaires that never thought they would have money invested early, and that's one stock that took off, and some of them have all their money in it. I think that's a little unwise when you look at ideas, a diversified portfolio, so that you get the upside of the market, but you can't argue with somebody that's had some success. Some people try to stock pick and get that next NVIDIA and end up either winning big or losing big. Some people say, man, I can't decide, so let's just index. So back to your index question, why would we index? Well, if you buy the S&P 500, a SPY, which is a ETF, an exchange-traded fund, you can get basically the S&P 500. There's even an equal weight, which is not cap-weighted S&P 500 index you can also buy, where you don't have that skewed to the big boys that are maybe overweighted and overvalued. Not necessarily overvalued compared to some, but bottom line is there's ways to play the indexes that might give you more of a sense of, I guess, peace of mind, because you don't have to stock pick. As money managers in our office, we do research and we do pick 20 or 30 stocks at any given time if we're going to pick a growth fund. And we use momentum and fundamentals and different matrix to make our decisions on what to buy. And lately we've been able to beat the indexes, but that doesn't mean we can all the time. We're aggressive. Most people get information late after the fact, after it's on the news. Well, by that time, all the insiders, all the market makers, all the hedge fund managers, all the congressmen who get inside information, they've already made their decisions. They've already bought the stock, and then they hope the retail investor jumps in, drives it up so that they can sell it. And then when it goes down, the people that got in late wonder why they're losing money. So indexing is probably a way for the layperson to get the long-term benefit of growth in the stock market without having to stock pick, do a lot of research, and just let the market do what the market does. Having said that, if you look at where the market is, when you look at price earnings ratios and some of the fundamental standards that we've kind of used for when it's wise to get in the market, when it's wise to get out of the market is extremely overvalued. I mean, it's only been overvalued like this, like twice in history. And I think we're knocking at the door, if not at the highest level of what we're willing to pay for a stock based on its earnings and based on its growth than we've ever been. While there's some stocks that are still, seemingly good values and growing at a faster rate of growth in their stock price, or their earnings, or their stock price is growing at a slower rate than their earnings, which means good. There's some catch up in there. There are some of those gems out there to be found, but they're fewer and far between. And maybe smart if you have a long-term horizon and you want to do it yourself, or if you're young and you're just putting a certain piece of your paycheck away, or if you're investing in a 401k, going into the index is probably the safest way to build long-term wealth that I know of, because you're dollar cost averaging in. You're not having to stock pick. You're buying, if the S&P 500, for example, is kind of the standard, that's 500 blue chip stocks. These are 500 of the biggest, most established companies that have a history of earnings, history of growth, history of probable positive outcome. That doesn't mean they all go up. I mean, shoot, we've had more stocks go down than go up in the last few years, even though the index goes up. And that's because the ones that are cap weighted and that have the most pull on the index are the ones that people are buying and making go up, and the others are somewhat lagging. But again, having said that, the index is a way to maybe take some of the, not the risk off your plate, because the market, the S&P crashed 50% twice between 2000 and 2010. And it wasn't until 2014 that the stock market got up to its prior highs in 2000 and stayed above that level, 14 years. So we could have a lost decade or more if you are not careful, if you just park and you just want to hold your money and just hope someday it's higher. However, if you're systematically investing for 10 or 15 years down the road and you're putting money in the market every week from a paycheck or from savings or from excess earnings or even excess withdrawals from your investment accounts in retirement, but you want to reinvest them, dollar cost averaging in the market by using indexes, in my opinion, is a smart way to go.
Talking with Jeff Ogan of Premier Retirement Planning and Wealth Management with an office right here in Tucson. We also have an office up in Mesa. We're talking about direct indexing versus mutual funds or ETFs. If our conversation piques your interest again, you can give us a call here at 520-780-9059. It's 520-780-9059. If you'd like to schedule a consultation with Jeff to answer any and all of your retirement questions, anything on your mind, we can talk about it. There's no cost, no obligation. 520-780-9059 is our telephone number. Make that call. Shelley will call you back and set up a time for you to talk with Jeff. Jeff, is direct indexing for everyone, or do you see it working better for certain types of investors?
Well, I like it for the person that doesn't have time to watch the market and is kind of the do-it-yourselfer is probably the best one, a direct index. Like I said, dollar cost averaging, that typically indicates a younger investor who's still working and earning a living by a paycheck and saving the excess. So, I mean, I think indexing works great. I think if it's long-term money that you just want to park and hold until you die, maybe it's a legacy plan. Maybe you just want to park it in something that is indexed to the market and not worry about it because you know you'll never need that money. Let it go up and down, doesn't matter. Maybe in that case, it's something you can do. Again, I think the indexes are more for the do-it-yourself, where there are times when we use ETFs, which are exchange-traded funds that are the index itself. But more often than not, what I like the indexes for, and indexing isn't probably the real answer to the question as you got it off the internet or heard it, or as is normally talked about by Wall Street, because all they believe is stocks and bonds are the only thing, and it just depends on how you package them, is how you invest for, now, the future income or whatever. I don't believe that. There's other opportunities that are a lot safer and generate more income. And those are insured, secured products that have principal protection. And you don't get principal protection in the stock market, even if you did a bond index. I mean, there's the bond index for the last year is down 3 or 4%. That's all the bonds. If you look at a 20-year bond ETF, exchange traded fund that has all 20-year bonds in it, look it up. It's TLT is the ticker. And it's down, I think, 15% from a year ago. You can lose money in bonds, even though they're supposedly packaged up to provide that income that you need. But most people aren't just living off the 3 or 4% interest. They're expecting the bonds to actually grow enough in value so that if you need money or when you need money and you liquidate those assets, you're not taking a loss. Well, that's a different story now that interest rates have gone up for the last few years and continue to go up as people sell bonds because either they don't trust the government either they're raising money because the economy's not as good as we think, or they're selling them because maybe foreign countries are selling them in order to pay retribution for the tariffs and things like that. I know China's been dumping a lot of bonds. If you make the bond prices of long-term bonds go down, or the prices because you're selling, then interest rates go up and it hurts the economy. So there is kind of a retaliatory effect that's probably been happening with bonds, and you can do bond indexing as well. But some people think, well, I don't want the risk in the stock market indexing with the NASDAQ, the Dow, or the SPY, or the S&P 500, or even the Russell, which is IWM, which is an ETF that follows the Russell 2000, which is more of a broad indicator of the market, which, by the way, has not really performed all that well and is a bigger indicator of what the overall stock market or the overall economy is doing. And if you watch that Russell 2000, you get a better indicator of how things really are rather than how a manipulated cap-weighted index performs based on how the market makers overbuy or oversell particular stocks. Back to the indexing and where I like indexing on principal protected products, which are offered by insurance companies. I like LERPs. I like indexed annuities. I know there's other radio shows and people that are on the radio just, oh my gosh, hate the LERPs. Oh, hate indexed annuities. Why would you ever do that? Well, first of all, they must not understand them. They must not have clients that want to protect their assets. They must not want to provide long-term tax-efficient retirement income, or they flat out just don't know about it because all they've been is a stock and buying Wall Street guy. And if that's the case, you don't understand it. Well, of course, it's easy to dog on something that you don't understand or you've never used, or your clients aren't necessarily the clientele that need kind of a thing like that. Now, my clientele are typically, higher net worth that have a tax problem, that like tax benefits. They also like income in retirement because they're used to making a lot of money from their jobs, and they want to make sure that their investments generate a lot of money in retirement. And if that's the case, then you use principal protected assets and we can index off them. And how that works is the insurance companies can take all the risk. They will invest your principal in a laddered bond portfolio where they take all the risk between the bonds going up or down in value, but they get the interest off of that bond account or their investment account every month, and they invest it in options on the indexes in the market. In other words, they're betting on the market to go up. If the market goes up, they might be able to double or triple the interest you could have made on your money. And they give it to you, minus maybe 1% that they keep for, management, which is typically what you'd pay a mutual fund manager or an advisor or anybody else. The nice part is insurance companies have such big economies of scale. Not only can they protect your interest, while they may have invested in bonds with your money and the bond market is down between 3 and 15%, depending on what kind of bonds you bought, they're taking that risk, yet you could be making 5 and 10 and 15% a year on some of these indexes that they can leverage and invest in. So you can actually do better indexing with leverage, letting insurance companies that protect your principal use the indexes to get upside when the markets or the indexes that they use go up. And by the way, not all indexes go up all the time together. Just because the stock market seems to be propped up right now, and honestly, if you look at it, the stock market is like the only thing going up. Energy stocks, if they're in the nuclear energy or the energy field, are going up. But if you look at oil and gas, they're flat to down. If you're looking at gold, it's been flat for a while. If you're looking at bonds, they're down. Really just the stock market has gone up. A lot of commodities have gone down. The economy really isn't as robust as everybody on TV wants you to think. It hasn't been, and we've been real about that. The economic indicators have been declining over the last 30 or 40 months. And that's not a good sign economically. It usually means that eventually there's going to be some sort of a recession and probably a market sell-off when the balloon pops. But right now, the balloon's still full of air. It's still holding air, and there's still opportunities in the market to go up if you have the stomach for it, or if you have the risk tolerance for it, or if you can afford to lose money or wait on that money to come back. In the meantime, if you don't and you want to principal protect, but you still like the idea of indexing and getting some upside with the market, then use the indexes that come with insured products that are insured, secured, double, triple insured. Shoot, they're not only insured by your actual asset, they're insured by a surplus that the insurance company has. They're insured by the reserve that they're required to have. They're insured by the interest that they make on those accounts. They're even insured by state guarantee funds and other things that back up all the strength of these companies to where you can feel confident you're not going to lose your money. You can't do that in the stock market. You could do that in a bank CD, maybe, but they don't even have your money. They loan all your money out, and if things go bad, they've got to tap FDIC, an entity that's absolutely broke, to somehow pay you back your money. The insured secured products that we use are much more solvent, much more secure. They actually have your money. They actually have extra money. They actually have even more than the extra money that they're required to have, in addition to the backup insurance security programs that insure those accounts. So I like using indexing on those things that are safe. If you have a long-term horizon and don't mind the risk, then indexing, getting all the upside and all the downside might be right for you. But that's typically for somebody that has a lot higher risk tolerance, isn't probably on the brink of retirement or in retirement, using the money to live on, or they're typically younger, earning money, have excess earnings they want to invest for the future.
520-780-9059, 520-780-9059. And we're going to continue our conversation in just a moment. Again, I want to remind folks that if you'd like to talk to Jeff about direct indexing, mutual funds, ETFs, anything we talked about today, no cost, no obligation for that. All you got to do is make that call to 520-780-9059. Jeff, you had mentioned high net worth individuals just a moment ago, and a lot of people listening today have fairly straightforward retirement needs, but high net worth investors often face more complexity. So let's start with the big picture, Jeff. What makes the retirement planning needs of high net worth investors really totally different from the average retiree?
Well, I think the tax component becomes a much bigger deal. You know, obviously, the higher the net worth, the bigger your potential required minimum distributions are going to be on your qualified account, your RMDs and your 401ks, your IRAs. If you haven't converted to a Roth, and you probably didn't when you were in a high income bracket, in order to get to a high net worth, you typically probably had high income or were a really good investor, or maybe inherited something from a rich uncle. I don't know, whatever. The fact is you've got money, and now what it generates could be high enough income to put you in a higher tax bracket. So I think the tax component is probably the biggest thing. The other thing is I think even high net worth people are, even though some of them think that they can withstand tons of risk, when it gets time to retirement, they're not making $300,000 or $400,000 a year anymore between them and their work, or even seven figures, some of them. They still want a few $100,000 a year. If they're used to living kind of large and they've got expenses and they've got lifestyles that cost a lot, comparatively speaking, they're going to want some of that income guaranteed so they can continue to live that lifestyle, rather than, you know, if you've got $5 million or $10 million, I think that's considered a high net worth. I think that the mass affluent market is kind of the $2 to $5 million person. I think anybody over $1 million is still kind of in that high enough net worth to worry about taxes. So I'm not talking about just those people that have millions and millions of dollars. It really trickles down. But I think the more you get past the $1 million mark, or even the more you approach it, even if you're in a lower tax bracket and you just hate taxes, we can still do tax planning and do the same thing we do for high net worth people for the lower net worth people. Every dollar you save in taxes is a dollar you don't have to go out and swing harder to hit the ball farther, taking a chance on making risky investments. If you can save money in taxes, then you don't have to try so hard or be as aggressive in your investment profile. The other thing is some of these tax advantage planning techniques and the products that we use guarantee income at a higher level than the typical rule of thumb rates, like the 4% rule or now the 3.4% rule based on a recent Schwab article. If you've got $1 million and the safe amount of money is $3,000 or $4,000 a month, or $30,000 or $40,000 a year is max in order not to run out of money because volatility could set in. Yeah, what if you could put half to 3/4 of that money and get $40,000 or $50,000 in guaranteed income and make the rest aggressive and in a more tax efficient way? The other thing is when we do income planning, we already predetermine what our future tax brackets look like so that we can make better planning decisions around those tax brackets as we manage the rest of the money. If we need a place other than Roth conversions or Roth IRAs to sock away tax-free money, we use LIRPs, life insurance retirement plans. And just because a rich person benefits the most by a Roth IRA, the income from a Roth or income from a LIRP, life insurance retirement plan. They call that the rich man's Roth, by the way. Doesn't mean people in a 12 or 22% bracket can't take advantage of it too. I mean, if you hate paying taxes, I hate paying 12% taxes. I hate worse paying 22. I hate worse paying 30 or 40. But, if you like to keep your own money legally in your possession so that you can spend it in your community with your family and leave it as a legacy to those people you love and care about, then why send it to the black hole in the IRS, the black hole in Washington? They just throw it away. If they spent my money more wisely, maybe I'd be less upset about paying taxes. But I think tax planning is really important, especially for those people that have had a tax problem throughout their life and know they're going to either have the same tax problem in retirement or even a worse tax problem as they get older and need to take more and more money out of those tax deferred accounts and get their butts kicked, figuratively speaking, from the tax man. So that's probably the biggest thing. The other thing is the higher net worth people have more opportunities to be a little bit more comprehensive. They can use income from annuities. They can use income from life insurance products that are tax-free. They can use different managed accounts. We have 4 basic portfolios, different risk levels that we manage. We also have access to hundreds of managed accounts by hedge funds and other things that we can track through Morningstar and other reputable sources to track progress and see how the trades are going and pick managers that are really good at managing risk for those assets. But again, not everybody wants to just keep it in stocks and bonds. Just because you got to retirement by investing in stocks and bonds along the way, and they did well over the last 40 years, doesn't necessarily mean that when you do a 180-degree turn and go into retirement and start using that money for retirement, that is the same strategy that makes sense to use through retirement. The higher net worth people have the ability to really diversify, not just amongst safe and moderately risky and super risky investments that are available on Wall Street, stocks and bonds per se, not just mutual funds either, ETFs. We can strategize with a lot of other products. We can, accredited investors can get into private equity. We've got the new private equity opportunities coming that will be real estate involved that we can put together. My son Taylor, who's worked in that business as a CPA, knows how to manage portfolios. We're working on putting together a real estate private equity program that should net over a 10% rate of return, that kind of a thing. But you can't do that unless you're an accredited investor. So there's opportunities that we have available and that will come about because of the fact that we serve higher net worth people. We need to look for more opportunities. It creates a bigger incentive for us to be more comprehensive and be good at the comprehensive plan. And so the people that we serve are pretty homogenous from the standpoint that they have very similar needs. They want to preserve their assets. They've worked hard for what they have, whether it's a small amount or a large amount or a super large amount. They want to protect it. They want to create income from it. They want to pay less taxes. They want to make sure that if they ever need long-term care, have some sort of an ailment, that they're okay and they're not going to leave a spouse or loved ones hanging. And then they want to leave their assets to who they want, how they want, with the least amount of trouble, taxes, no probate, and as tax efficient as possible. So those are the main pillars of planning that we incorporate. And obviously the higher net worth person needs that more than anybody. And unfortunately, doesn't get it at Merrill Lynch very often. In fact, I don't even know anybody at those big box firms that even claim to give tax advice. In fact, they say on their own brochures and every prospectus and every form that they hand out to you, we do not give tax or legal advice, consult somebody else. Well, that's kind of weird. You bring your lawyer, your accountant to every one of your investment meetings. You probably should if they're the ones giving you the advice. The problem is the accountant and the lawyer don't have any clue about the investments that the guy over at the big box brokerage firm is recommending to you. So they might act like they do because they don't like to look dumb because they're smart people, especially in their realm of expertise. But we've taken that on ourselves to learn those things, to incorporate them all together, and to focus on a client that has those needs. And that ends up being the bulk of who we serve. 80-90% of the clients that we serve are like the ones I just described.
If you're not having these conversations with your current financial advisor, you'd like to check us out, see what we can do for you, we invite you to give us a call here at 520-780-9059. There is no cost, there is no obligation whatsoever for us to take a look at the plan that you have. If you're doing okay, we'll tell you that, but if we find some blind spots, we can point that out too. Why not get a second, maybe even a third opinion? 520-780-9059 is our number. It's the number for your Premier Retirement Roadmap at no cost and no obligation. You can also find out more about us online at premret.com, premret.com. Jeff, let's take a break here on Premier Retirement. When we come back, we've got listener questions, and then we'll talk more about planning for Q4 here in 2025 and 2026 when our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premred.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you so much for making us a part of your weekend. You're listening to Premier Retirement with Jeff Hogan here on 790 KNST Tucson's most stimulating talk. We're on the air for you 4 times a week, Saturdays at 7 a.m., also 9 a.m. and 1 p.m. If that's not enough for you, we're also on Sundays at 11 a.m. And still, if that's not enough, we're also a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a successful retirement and growing your wealth. If you want to preserve your wealth so that you can have a better retirement, you want to create an income stream that you can count on, if you want to reduce taxes, Premier Retirement is the place for you to go. And we do have that Premier Retirement Roadmap that you can get right now by calling 520-780-9059. Okay, Jeff, let's get to listener questions. Our first one this week is Ed listening to us in Catalina Foothills. And Ed says, we recently came into an inheritance which includes about $500,000 in cash. As this is something that would be invested in an after-tax brokerage account, we have concerns about being in mutual funds that pay out capital gains dividends at the end of the year. Our current advisor suggested investing in direct indexing vehicles. I'm trying to wrap my head around what that is, how it differs from index funds and ETFs, and the relative pros and cons of each. Any light you could shed would be appreciated. And I don't know if Ed listened to the first part of the show, but it sort of answers this question to a certain extent.
Yeah, I don't know that. I think people are trying to split hairs with direct indexing and making it seem like a sophisticated way to do something different than just buying the S&P. But honestly, in my opinion, it comes out the same. I don't know that there's any nuances that make it any more likely to make money or lose money. I think it might just be a buzzword or some way to get transactions generated through the firm. And honestly, I don't get the strategy or how it would enhance what you're doing. You either put money in the market that's exposed to risk, or you take it off and put it in things that are indexed to the market that don't have risk through, indexed annuities, LIRPs, life insurance retirement plans that have a life insurance tax-free income component to it, plus principal guarantees and index upsides with no downside when the market doesn't perform. So we just skin the cat a different way. There's tons of ways to skin the cat. We do direct investing in the market in those stocks that have value, have momentum, have more buyers than sellers, that have a trend that's up, and we use trends. And right now when the market's overvalued, that's really all you can do, because fundamentals, if you just say, oh, this stock is really undervalued and it should be worth something in many years, it may or may not get any traction because it may not find buyers because everybody's buying whatever's being hyped on TV or what the president just talked about. Oh, we're going to make a big deal. We're going to do nuclear energy. Energy's great. Buy energy stocks. That's the new hot thing. Money's flowing into those things. If you follow the money, you can make money. If you do direct indexing because you're lazy and you don't want to do any research, which is what most brokerage firms do, then index or pretend you're sophisticated and do some nuance of the indexing. But I don't mean to poo-poo it really. Unfortunately, it's just overusing the index. I think most people don't really have a sophisticated understanding of the market and the investments. It's taken me a long time to be in this business to understand what I understand. And what I do understand is most of the Wall Street firms, if you're not the one making the decisions and on the inside of Wall Street, you really don't know what's going on anyway. You're just peddling risk and you're doing whatever your boss or the guys up in the ivory towers on Wall Street tell you to do and tell you to sell, and repackage it into something that's called direct indexing instead of just buying an index fund or just buying an ETF that correlates to the index. I mean, there's different ETFs that do the same thing as what you would do with indexing yourself. So, maybe it makes the advisor appear to be doing a little bit more work on your behalf so that you find value in that relationship. I don't think there's a whole lot of value if you hire an advisor and they just stick you into an index fund. I mean, you could do that yourself and save the advisory fee and have the same result, actually better results. Unless you need some hand-holding, unless you need somebody to do some tax planning, unless you need somebody to bounce ideas off, anytime you have a question, then it's worth paying a fee for perhaps. But if you're just looking at parking and holding and using long-term strategies, you could do a lot of the index stuff yourself. And if you want to do some of the direct indexing that takes an advisor, perhaps that's what they're doing, is make it a little bit more complicated. So it's something that you can't do easily enough on your own that you need the advisor. So again, that's my take. That's the best I understand it. We're not incorporating some of those strategies that you're hearing from your broker in our portfolio management because we just do it a different way. We don't look at it every quarter, every year. We don't park it and forget it. I mean, we're looking at it every day. Sometimes we'll rebalance. I had a guy come in yesterday, says, I looked at my statement. I had over 40 trades last week. Yeah, because we rebalanced. We took profits off of about 20 positions and we added some to stocks that were down that still have good value. And we sold some stocks that are dogs and we bought some stocks that have found new momentum and new light. We've also got some really good return history since we've been doing that. Now, it's not always good. We could also lose money. It's still risky. I'm not just saying we'll beat the market all the time and that we're so much better than indexing and stuff. We just do it different. That's all. Every advisor has kind of a different way of doing things. We've got enough experience that we can be hands-on. We can work for the client. We can generate a portfolio that's based on that person's risk tolerance and goals. And it's different for everybody. It's not just the same long-term portfolio like some people on TV that call themselves fiduciaries. We build long-term plans, and every stinking plan that I've seen by that company that's supposedly individual plans is the same plan. There's no individuality. It's just basically a cookie cutter. That's what they do. And they only cherry pick the results to show you when they made money and not the times that they lost money. I don't think that's being a fiduciary. I think being a fiduciary is developing a plan that has as much risk as you're willing to tolerate, that has the goal of not losing money first, but making money second, and not making you wait on gains in order to take money out to use to live on. So if those are your goals, we can do that without doing this direct indexing buzzword, which is no different than buying and strategizing or diversifying your portfolio into the different indexes rather than trying to stock pick.
Ed, thanks for listening to us in Catalina Foothills. Our number 520-780-9059. If you'd like to talk to Jeff in person, we'll send you out Jeff's book, Retirement: The Road Ahead. Next question, Jeff, is Mike in Vail. Mike says, I'm 63 and have adequate income for a successful retirement. I think it's too late for long-term care, and I want to keep a separate account to fund my long-term care, or if not needed, would go to my sons when I pass away. Do you have any recommendations for a low-risk investment that I could keep it in? I don't want it in cash. Maybe a money market? What's your opinion?
Well, yeah, money markets like cash. I mean, interest rates are decent right now, but they're probably going to go down. The Fed chair said he's going to start lowering interest rates, finally feeling the pressure with Trump. And I don't know if that's good or bad. I think the economy, because rich people are still spending money, still is supporting the market and higher interest rates. However, housing sales are down. Prices are big time down in Arizona. And there are some economic bummers that are happening because interest rates have been so high for so long and bonds have been being sold off. But if you're looking at asset-based, what we call asset-based long-term care, I do not like long-term care where you pay for the premium, especially at your age. When you're 63, by the time you're 90, those premiums are going to go up probably tenfold. And you're going to say, you know what, screw this. I'm not going to have this in this stupid account anymore. I paid in it all my years. I'm still healthy. I'm probably not going to go to a nursing home anyway. Bag it. I'm not going to keep paying more and more for it. And that's what the companies want. They basically bait you in at a low rate when you're 63. And then by the time you're 70, they raise it. Then by the time you're 80, they raise it again. By the time you're 90 and probably knocking on the door of using it, then they make it so unaffordable, they hope you drop it so they don't have to pay a claim. Or if they do, they've collected so much money from you that they'll never pay out as much money as they took in. So I don't like pay-as-you-go plans. I think they have turned into be a very big disappointment in the insurance industry. It's given the insurance more of a bad name than I think a lot of the products out there already have given it a bad name. Companies that never like to pay claims on everything from your car insurance to homeowners insurance to your health insurance, your Medicare supplements and Advantage plans, et cetera. But if you're looking at asset-based long-term care, that's exactly what you said, something that will generate a nice fund should you need it for long-term care. But if you don't need it, all the money you put in and then some goes to your heirs. What if you could do an asset-based plan? Let's just say you put $100,000 in there, but if you needed it for a rest home, it would pay $300,000. If you died, it would pay $200,000 tax-free. And if you ever wanted your $100,000 back, you could get it at any time just because you asked for it. That's a simplistic view of what I call asset-based long-term care planning, but those products exist and they're built exactly for that. They're kind of set it and forget it. Look, there's no way I'm going to lose money. If I want it back, I can get it. If I want to leave it to my heirs, they get it tax-free and they get more than I put in. But if I use it for long-term care, it's actually worth 2 or 3 times what I paid. Now, even more than that, if you want lifetime income, tax-free income, in addition to the balance of your account to go to long-term care, chronic illness, or even terminal illness, I love the LURP, especially at your age if you're healthy. If you're healthy enough to even consider long-term care insurance, I assume you're healthy enough probably to get life insurance as well. Life insurance, if cash value life insurance, if you stuff it full, you might be able to buy $1 million worth of death benefit for a few $100,000, and you can spend that $1 million while you're alive. Let's say you spend $500,000. Let's say you put $300,000 in, you spend $500,000. There's still $500,000 left for your heirs. But if you go to a nursing home and you need it, then you can spend as much of that $500,000 that's left for your nursing home care, and then the rest still goes to your beneficiaries. So I like asset-based long-term care. The LURP not only creates a tax-free income stream and a protection for a portion of your retirement assets, but it kills more birds with one stone than just the income piece or just the death benefit piece. It also covers chronic illness, terminal illness, and a variety of other things that might come up that you're not even sure about. It's the most flexible, tax-advantaged savings plan I know of. Very likely will average a better return than your 3 or 4% money market.
Mike, thanks for listening to us in Vail. And again, our number 520-780-9059 if you'd like to talk to Jeff. Next question, Jeff, is Dan listening to us in Marana, and Dan has a question related to being an executor. Dan says, hey, Jeff, longtime listener, first-time question submitter. My mother-in-law recently passed, and my wife is discovering the joys of executorship. This has us rethinking our choice of executor in our own will. We have no children and plan to leave the bulk of our assets to charity. Would it be unusual to specify in the will that it's up to the charities to assign an executor? I feel like I may be missing something here. What's my blind spot?
Well, if you're the executor and you're doing a will, I mean, that's the biggest mistake right there. If you have assets that have direct beneficiaries listed, then they go without probate. You don't really need an executor. Each heir can just make their request for those assets when you pass away. So if you know who you want to, give your assets to, just put them on as beneficiaries. You can put them on as a pay on death on a bank account. You can put them in ITF or a pay on death on a brokerage account. You can list beneficiaries on insurance, annuities, and IRAs and other accounts. You can even put a beneficiary deed on your house. Now, you can also do a living trust where you can pick maybe 1 or 2 people, maybe your children or a friend or a sister or brother, if you don't trust your children, to be the trustee. And they basically can take over. They don't have to work with the court system. They just have to basically sell the assets and divide the money and keep accounting. It's a lot easier than dealing with the court, probate, or all the processes involved there that you're going through, if indeed you're an executor and this is a probate issue. If you're a trustee and it's a trust issue, it's probably not as hard. But if you are finding it cumbersome or hard to deal with heirs, you might want to just use the direct beneficiary aspect and let each heir fend for themselves, getting their own share of each of those assets. And that's a lot easier to do than most people think. I believe that the legal industry loves you to have wills because it gets you tied to them when you die, and it's easier to build dead people than it is live people, I think, because the probate, when it ties your assets up, they know they're going to get paid out of those assets because they basically have control of those assets until the probate's done and they allow them to be distributed. So there's typically an overseer of that executor. So you're probably dealing with a lawyer, and then you have to appease all the people that want a piece of that action, and not to mention those people that might come from the outside and make claims that aren't even listed in the will. So try to keep yourself from ever being an executor or having one, because you're just basically dumping, like you found now, a big burden on someone that you thought you were giving a privilege to. You're actually dumping a big burden on them. So I like the direct succession through beneficiary designations. And if you need a little bit more backup than that, but you want to still keep it out of court and keep lawyers and some of the rigmarole out of the process, then the living trust would be the other benefit. I would also suggest that even if you don't do a living trust and you do the beneficiary designations, you should as well do powers of attorney, living wills, and those documents that, I would say are really living probate documents, those documents that typically come in a trust or will package. You still should have those in case something happens to you before you die, because powers of attorney work with you while you're disabled. A will doesn't. A will only works when you're dead. So you need all those aspects of your life and those possible issues that happen as you age to be covered. So make sure you have those ancillary, we call them ancillary documents. A living will, it says, hey, if I'm brain dead, pull the plug. Power of attorney for healthcare, it says somebody else can tell the doctor what to do with me because they know my values and my wishes should something happen to me where I'm incapacitated and can't discuss it myself. And then who pays the bills if I'm laid up for a while? Who's going to do the financial power of attorney and stuff like that? Also have a backup will just in case you need a will. I hate to even think you do, but if you do it right, you don't ever need the will, but it's better to have and not need than need and not have it, because then the court pretty much just uses their order of succession, and it may or may not be what you want.
Jeff, in this case, Dan and his wife do not have any children. They're looking to leave their assets to charity. So what would be the easiest way for them to leave their assets to charity that may not involve an executor?
Well, you could do a charitable remainder trust. You could actually do a trust and have a trustee, somebody you care about that would actually make sure that that asset gets to that charity. I had a friend who was the endowment counselor for Boy Scouts. And of course, they took kind of a left turn along the way. And a lot of people that had already set up their assets so that Boy Scouts would be glad to distribute all their assets how they wanted, as long as you left them some. They would do all the work. They would basically do all the dirty work for you when you died. When those people had already signed kind of an irrevocable trusteeship or assigned them the duties of passing out their assets, and then found out that the Boy Scouts wasn't necessarily, held the same values as they did 20 years ago, sometimes changing it a little bit hard. So if you let them be the trustee and you kind of make something irrevocable, you're kind of stuck. So make sure that's revocable, that you have the velvet hammer. You can change the trustee at any time. And maybe you do have somebody that you trust that's not necessarily a child, but somebody that cares enough about you that can make sure that whatever charity you list on the last page of your trust at any given time is who gets all the money. Then they just liquidate everything, hand it off, and take a small trustee fee to do that. So a living trust might be the best way to do it. Charitable remainder trust, if you already know the charity, you're super happy with them. If it's your church or whatever, you'll never change. Maybe you set it up to where they have an endowment person that, can help distribute those assets. And since they're going to get the assets or the bulk of the assets, they would probably help you do that. It wouldn't be like you have to pay an outside trustee to do the work, because they'd be getting the benefit. They'd be happy to do the work.
Dan, thanks for listening to us. And again, if you have any questions, 520-780-9059. Would love to help you out. We appreciate you listening to us here on KNST. If you have a question for us you'd like us to answer on the air, you can get it to us two ways. One of which is you can call us at 520-780-9059. Have Shelley take down the question. She'll give it to us to use on the air. Or you can go to the website, which is premret.com, premret.com. Use the contact page there. If we answer it on the air, of course, you'll not only get a great answer, but you'll get Jeff's book, Retirement, The Road Ahead. Anything in our program today piques your interest, you'd like to sit down, have a casual conversation with Jeff about whatever's on your mind? Again, we are offering that. We call it the Retirement Roadmap. There's no cost, no obligation for that. And again, the number to get it, 520-780-9059. You can make that call this weekend while you're listening to the program. Leave your name, telephone number. Shelley will give you a call back, and she'll set up a time for you that's convenient for you and Jeff to have that conversation. Again, not going to cost you anything. Totally complimentary. 520-780-9059. Well, Jeff, here in September, we're at the end of Q3, almost in Q4. A lot of people are thinking about their financial plans, how they perform during the first 3 quarters of the year, how they may perform the last quarter, and how we may set up things for 2026. Is this something that you do at Premier Retirement? Is take a look at how things have performed during Q3 and make a plan here for Q4? Or really, how do you handle this sort of thing?
Well, I don't think there's any particular quarter deadline that makes any changes. We look at everything daily, and if there's something in the middle of the quarter that we think needs a change, or if there's some new policy that comes out, or tariffs start in April, and we want to make changes based on April, not based on, March 31st was the end of the quarter, we have to wait till July now. If there's something that changes, we want to make the changes on the fly. We don't want to wait. So, I would say a quarter makes no difference. I mean, it's nice to see quarter to quarter whether companies are making money, whether the economic indicators are going up or down, quarter to quarter whether GDP is getting better or worse, quarter to quarter whether unemployment's better, interest is better, inflation is better. Those are all stats that I love to get the feedback on that the government gives us to kind of help us know how things are going. But as far as the investment strategies, typically, we look at a 30-year plan and we look at the whole 30 years. And honestly, I don't like making changes from the standpoint of planning, except maybe on an annual basis. We bite it off in year chunks. That doesn't necessarily mean December to December. If you became a client in September, maybe a September to September is the year that we use, and we revisit it and see how the year did. But you can have a bad quarter and it might look like you're going to have a bad year, and then you have a great quarter to end the year and you end up having the year that you expected or that it averaged out. So I don't like looking back in periods of less than a year, especially if you're trying to figure out what your annualized rates of return are. You can take one good quarter, times it by 4, and have this super good annualized rate of return, or you can have a flat quarter and say, oh my gosh, we're making 0. Not true. So again, you have to look at the overall picture. I also don't mind that, when you're doing a 20 or 30 year plan, if you have a few sucky years, who cares? It's a 20 or 30 year plan. They're not going to all be bad, and the other thing is just because you have a few good years doesn't mean you're going to make 20% for the rest of your life either. There's going to be a correction. You're going to give some of that back. And that's just inevitable. That's just the way it works. So use a relatively conservative estimate of rates of return, go with that, update your plan every year, make sure that your goals haven't changed. If something happens in between a year that somehow changes your planning outlook, your goals, that kind of thing, then have a meeting with your advisor and update the plan and say, hey, we changed our mind. We're going to do this. We're going to move and live on our cabin up in Shola. We're not going to live here anymore. We're going to sell a house. We've got this extra money. How does that affect our plan? Well, okay, let's change the plan then. But when big things happen, then you change your plan. But just because a quarter comes up doesn't mean there's any need for changes, in my opinion.
Jeff, what about taxes? What should people be focusing on right now before we get into Q4?
I don't think Q4 matters. I don't think if it matters between Q3 or Q4. The fourth quarter is the last quarter of the year. I think during that last quarter, you might want to start gathering up and figure out what tax bracket you're going to be in, because maybe at the end of the year, you want to make a Roth conversion and pay a little bit more taxes now so you don't have to pay taxes later. Maybe you're funding a LERP and you want to know how much of your IRA money you need to take out. So, those are the fourth quarter decisions you make, but they could be made earlier in the year. But if it's income related, as you get closer to that end of the year, you're going to know how much taxable income you have, or be pretty close to that. The other thing is some people don't know what they're going to get as far as 1099s or earnings based on their mutual funds and other things. There are ways to log into your account and find out what your year-to-date taxable income picture looks like so you can add that to your income before you make a big mistake and push yourself into a new tax bracket because you get a whole bunch of 1099s in January and February next year and find out you made money on investments that you forgot to include in your calculations for Roth conversions, IRA spend downs and things like that, or even, how much charitable gifting you need to do, direct charitable contributions, things like that. So I think it's time to start regrouping. We're not really there yet. We're getting close to the end of the third quarter. But come October, November, you probably ought to be setting an appointment with your advisor for late November, early December, not the end of December, but early December, just to find out if there's any final tax changes, especially if you are a tax planning client and you have tax issues that need to be solved. It's good to just have another review. Even if you have a plan and it looks like it's all intact, it's probably a good idea to take one last look at it just before the end of the year. That's what we do all December. It's really just reviews. We don't do a lot of new business. We don't try not to take a lot of new clients because we have so many clients that have tax planning issues that we pretty much are back to back with those people just doing last minute reviews, making sure that we're not going to put ourselves in tax jeopardy come January 1 when it's too late to make changes.
So again, this is September. We're at the end of Q3, almost Q4. Better to get a handle on these things before it becomes too late, and especially as it relates to taxes, as you said, harvesting tax losses if the market's been volatile. You might want to figure out a way to manage capital gains and selling positions strategically before the year end. So Q3, the time to model these strategies, waiting until December certainly can limit your options. Jeff, we get questions here all the time about your book, Retirement, The Road Ahead. Can you tell us a little bit about what that's all about, how people can get it?
Yeah, you can download it off the internet. Just go to our website, primret.com, go into resources, and there's an electronic copy. Feel free to download it. It's an easy read. If you want a hard copy, come by the office. The mailman doesn't like sending books. It's really a pain in the butt, to be honest with you.
Right.
You can buy them at Amazon, actually. You can buy them from Amazon cheaper than we can mail them to you. That's the easiest way to get a copy of the book. If you want to get a hard copy, swing by the office, meet us and greet us and come in for a review. We'd be happy to give you one. The book is really just an outline of questions you should be asking yourself before you basically build your retirement roadmap. Yeah, and that's what we do here. Premier Retirement Roadmap is really your 30-year plan or 40-year plan, however much time you have left, as to how you're going to spend your money to make sure, first of all, you protect those assets, and how you spend your money to make sure your lifestyle's kept up and your goals are met to the extent that it can be. Sometimes people come up a little short and need to make adjustments. Some people, in fact, most people I find are in much better shape than they think, as long as they don't put themselves at risk and lose money. If you don't lose money, some people have the ability to live just fine if they don't keep taking the same risk that got them there. Sometimes taking risk gets you to a really good place, but taking risk can also get you to a really bad place if you're spending that money in retirement and the market's down when you need that money. So those questions are answered. There's a section after each chapter, a note section. Some people actually print the book off, or they just print the chapters off, or they just print the note pages off with the summary of the chapters that they want to address. And they'll just write down their notes. And some people will bring that in to us and say, hey, these are the questions that I had when I read your book. These are the things I want to address. And great, we'll still look at the comprehensive plan, but those are the focal points of your plan can be more easily addressed if you've already read the book and you know what those things that stand out that either bother you, or you find out you might be a little bit short in knowledge about, or maybe short in the planning process about those certain things. Some people have a great big 401k. They have no idea how to create income. They have no plan for taxes. They have no plan for long-term care. They have no legacy plan. They have no idea how they're going to leave it to who they want, and they have a lot of questions. They're not sure what their risk tolerance should be in retirement. So we can go over all those different things, and that's only 5 pillars of planning, but there's 10 or 15 chapters in the book that talk about everything on what happens if you take Social Security at different times as opposed to other times. There's some things that have changed in the last 4 or 5 years that as we wind down with our last 50 or 100 copies of the hard copy book, we're revising a few of the chapters so that we can do our next edition and have some more of the new information. But when you come in for the appointment and develop your retirement roadmap, the tweaks to those chapters are not significant enough to, say, oh my gosh, I don't have an up-to-date book. The book is very up-to-date in the fact that it helps you think the right things, ask the right questions so that we can give you the right answers.
The book is called Retirement, The Road Ahead. You can get it at no cost by downloading it at primret.com, PREMRET.com. If you want a hard copy, make an appointment to talk to Shelley, or you can just swing by the office. We got a couple left that we can give to you. Jeff, very good conversation today, but we're out of time for this week. I want to thank you for your time, but most importantly, as I do every week, I want to thank our great listeners for joining us here in the greater Tucson area. So for Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.